Keynesian policies never work. They always leave a trail of debt behind them. And the latest Congressional Budget Office projections prove it. Let's look at some graphs. In this graph, table, courtesy of the Congressional Budget Office, what we see is that in their latest projections, the deficit is going to soar. But we need to think about the premises that they're using. Number one, no recession. With the economy growing at the potential level, around 2%, what they expect is, number one, no recession. Number two, record tax revenues, and that in the period from 2024 to 2034 is still going to leave behind a monster deficit that is going to rise from 1.9 trillion to 2.8 trillion. The primary deficit rises, but more importantly, the debt is going to rise by almost 20 trillion in that period, 2024 to 2034. The deficit doesn't come down despite record tax revenues, no recession, economic growth and increasing employment. The estimates are truly staggering, because when you look at what is happening is literally that outlays, expenditures, are going to soar to all-time highs, more than almost 3.5 trillion increase in mandatory outlays and top level of expenditures. Let's go to the next graph. Now this is very interesting, because a lot of times you will read that everything would be solved if it wasn't for the tax cuts that have been implemented in the past. If we had the tax revenues of the past, then things would be better and we wouldn't have a deficit. Well, this proves that it's completely false. The average of revenues between 1974 to 2023 has been 17.3% of GDP. What the CBO expects is revenues rising to 18% of GDP. Yet, the average outlays, which have been 21% of GDP between 74 and 2023, are going to soar to 24.9%. And this is important. The CBO expects discretionary spending to actually come down. This is quite unlikely, regardless of who wins the elections. Let's go to the next graph. If we look at the next graph, what we can see is, where is that deficit coming from? Number one, primary deficit, okay? If the United States doesn't implement pro-growth policies, primary deficit is going to continue to be absolutely staggering, about $1.1 trillion. But we have to look at another very important factor. If the United States continues to build debt, net interest expenses are going to rise massively, even if interest rates are cut, and even if the Federal Reserve continues to support the economy. And if we look at what has helped the US economy reduce its imbalances, what we can see is that between 1981 to 1994, pro-growth policies in which what we saw first are significant budget cuts, significant administration levels in which what we would see is that there would be a prudent level of government expenditure, and pro-growth policies that drive more economic growth, higher level of entrepreneurial activity, more investment, more consumption, better wages and better employment. All those things between the 80s, more or less around the mid-80s until 1994, were the things that worked. So, what we can see in this graph is that the only thing that can really stop the bleeding of deficit in the economy is pro-growth policies driven to attract investment, attract higher growth, generate higher levels of real employment with higher real wages, not policies of increasing entitlement spending, increasing the size of government and the economy, which lead to stagnation and increasing taxes. This is the proof that the Keynesian method doesn't work at all. Let's go to the next graph, which shows us why this doesn't work at all. Consumer confidence. Consumer confidence plummets yet again, not only in current situation, but also in expectations. And why is that? Because citizens are feeling the pinch of inflation, and they're also feeling the negative effect of higher taxes. A double negative created precisely by those Keynesian policies. And by the way, when they say that they are going to tax the rich, they always tax you. It's the easiest trick to increase taxes to everyone. Consumer confidence plummets. Let's go to the next graph. In the next graph, what we see is that so far, the US dollar is strengthening. It's not just strengthening relative to the euro and the yen, which is the white line courtesy of Bloomberg, but also relative to the weighted average of the currencies with which the United States trades. Okay, fair enough, but that is fiat currencies versus fiat currencies. See what I mean? Is that the dollar is losing purchasing power in itself, but others are losing more purchasing power than the dollar. What we are seeing is currency debasement. Let's go to the next graph, which also shows us a very important factor. Inflation. Persistent inflation. You cannot expect inflation to come down if deficit spending continues to go through the roof. This is absolutely staggering when you look at the fact that it's going to be a minimum $1 trillion of primary deficit, which means more money printing. Deficit is money printing. And obviously, persistent inflation is caused by constantly monetizing the deficit spending and the imbalances of the government. So, this is in the United States. Let's look at what is happening in the euro area, no? Let's see the next graph. In the next graph, what we can see is that the euro area saw a brief moment of bounce in the PMIs, in the Purchasing Managers Index survey, and what we see now is, in the latest one, is that it's plummeting again to new lows. And the euro area is the future of the United States if it continues with these policies. The euro area, enormous government spending, enormous debt, massive taxes, and obviously stagnation. Let's go to the next graph, which shows us the poster boy of Keynesian policies. Oh my God, it's Japan. Japan with an enormous level of debt, in which, despite very low interest rates, the government spends about 20% of its budget in interest expenses. Look at this. The PMIs show a small improvement in manufacturing, but still at very low, very low levels. More importantly, if you look year on year, it's only a small bounce coming from the slump of the previous 12 months. But let's look at services. What does Japan tell us in services? If we go to the next graph, we can see that in services, the economy in Japan is weakening very rapidly. Those business activity services PMIs have gone down dramatically to 2021 levels. That is what Keynesian policies do. Keynesian policies make everyone poorer, make governments larger, and they make economies weaker. And it's always the same effect. More debt, more taxes, less growth, less productivity growth, and the recipe for stagnation. Keep defending freedom.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.